Hello and welcome to Bullion Star. I'm Claudia Merkert and today I am joined by Dr. Nomi Prins. Nomi is a former Wall Street Insider, best-selling author, investigative journalist and founder of Prinsight's newsletter. Nomi has dedicated her career to uncovering the hidden forces driving our economic future and is a leading voice on global finance and geopolitics. Nomi, thank you for joining us at Bullion Star today.
Thank you so much. I am so glad we are having this conversation at this time.
Having followed your work for so many years, I'm so grateful that you agreed to be interviewed on our channel today. I wanted to start off by speaking about your very interesting background. You've had such a remarkable career trajectory from top roles at Wall Street investment banks like Goldman Sachs and Bear Stearns to becoming one of the most respected independent voices on financial integrity and economic inequality. So please, can you tell us what led you from the heart of Wall Street to focusing on gold and precious metals as part of your bigger picture view of the financial system?
Yes, thank you so much for that question. I think it always comes more into view the longer the number of years are that I have been on Wall Street. But yes, I did start my financial career on Wall Street. I worked in London. I worked for the firms you mentioned and other firms. And during that time, I focused primarily on bonds and options and futures and to an extent commodities. And what was always interesting to me was looking at the real economy, the one that works in the physical and operates for people, the one that has supply chains, versus the sort of financial aspect of that economy, which the through line for me having left Wall Street to where we're having this conversation today in the decades to uncover the reasons why the real economy and the financial system are so disparate. That's one of the main reasons why I came to where we are at today.
Well, it's really interesting how being right at the center of Wall Street can actually open your eyes to what's not working in the system. So I could see how that would lead you to start looking at gold and other assets in a new way. Now, since you've left Wall Street, you have become a best-selling author. And in your most recent book, Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever, you describe a world where markets no longer reflect economic fundamentals. How would you say this distortion is playing out today, particularly in light of the US's ballooning debt and the impact that's having on the perception of the US dollar globally?
Yeah, so when I wrote that book, it was in the middle of COVID. My prior book, which was Collusion, How Central Bankers Rigged the World, which was all about how all of the main international central banks basically tried to save their own countries and themselves in the wake of the financial crisis. And that entailed rates going down to zero, central banks invoking something called quantitative easing, which is effectively purchasing the debt of their own governments to bail out their own financial systems. That's what QE doesn't stand for, but that's what it is in practice. And so by the time we got to COVID, there was this system in place that had changed the rules of the relationship between the real economy and the financial system, because you could have these artificial insurrections really from the standpoint of central banks infusing the markets with fictitious money that did not come from earning or building or technology or infrastructure development or really anything. It was just purely fabricated. And that's the financial system that we still have today. And in the wake of COVID, I looked at it as not simply a manifestation of what happened to save the financial system from the financial crisis of 2008, but it had evolved into saving any part of the banking system from any emergency that could impact it, as was COVID. And so the idea of a permanent distortion is that permanent disconnect between what constitutes value in terms of real assets and real long-term developmental growth using those real assets and this ability to create fiat currency and to balloon debt. And a few years later, since that book came out, we're now, as you mentioned, we're looking at U.S. debt ballooning towards $37 trillion. We're looking at a deficit moving towards $2 trillion. We're looking at almost $1 trillion per year, which you could look at as half the deficit, just going to interest payments on the debt, which is increasing and which will increase no matter what form this budget that's in talks right now passes. And so we really have unmoored this idea of sort of fictitious pushing forward the availability of debt to do something really non-transparent with commodities, real things from the real earth that have real value and real lasting permanent roles in the development of real economics and the real world.
So we're seeing, I guess, countries increasingly questioning the dollar's dominance, especially China and the broader BRICS bloc. So do you believe that we're now witnessing a structural transition away from the dollar as the world's reserve currency? And what role do you think gold might play?
There's a couple of steps in that. So what it is there's the dollars you mentioned. Is it going to stop being the reserve currency in our lifetimes? No. But is there a movement and an accelerating movement to go away from using the dollar as the base trade currency amongst countries? And what does that manifestation of moving away from the dollar entail? That's a really interesting question, because what China has been doing, for example, is been shunning U.S. debt, and it has been purchasing gold. So now gold is about 5 to 6% of its reserves from very, very little amounts less than 10 years ago. And as our debt has grown in the U.S., it's effectively increased its percentage of gold allocation and reduced its percentage of U.S. treasuries, or basically monetizing the United States debt. And in the process, the BRICS countries, as well as now BRICS Plus, which has opened up, in which there's members waiting to join, constantly has basically moved from an idea of economic collaboration to an idea of more trade and financial system collaboration, into which China is also a key player. China's payment systems are a component of that, as they're developing to include more of the countries with which it does trade. And there are many more agreements, trade agreements, for example, for oil, that work between Saudi Arabia and China directly without going to petrodollars, without going to use the US dollar at all. So what that looks like in practice is a little bit of what I was talking about with permanent distortion. It's basically countries utilizing their relationships to purchase and sell real assets. And so that's what we're seeing. And that really creates an extra polarization in the world away from the dollar and the debt-based system into, not that these countries don't have debt, but into moving away from being dependent on the US dollar, on US debt. It will still be a reserve currency in Maine. It has a very big head start, but this movement away is very important. And gold holds a very key role in that, because gold is the objective real anchor of this entire pivot away from relying on the US dollar, relying on US monetary policy, relying on US-based payment systems for transactions and to validate trade transactions around the world, for example, the SWIFT payment system. And gold serves in that way as both a tier one asset from the standpoint of it being utilized by central banks as a reserve asset officially, and therefore by the banks in their country, so it goes all the way down the chain, but also to potentially anchor these trade agreements. Not today, but that's where these payment systems, I believe, are going. And that's one of the reasons. The more that these countries outside the US dollar, outside the US sort of treasury purview, own gold and continue to buy gold, which they are, there is no stoppage of that, the more they have an objective lever against fiat currency and US dollar denominated debt, with which they can utilize to strengthen their trades with each other as sort of a backbone, like a collateral to their own systems. And whether that's a gold standard or just simply the availability or the reciprocity of owning gold in these individual reserve banks, it's still growing as what I believe will be a key component in international trade and in international diversification from US-centered dollar-based activities.
Well, I mean, there's certainly that story playing out in the East, with China's central banks steadily stockpiling gold now, officially and unofficially. And we're seeing major moves like the Shanghai Gold Exchange relocating a major warehouse to Hong Kong. Do you think China's quietly trying to remonetize gold through these moves?
Oh, absolutely, because gold now is becoming that anchor, that through line. So it's moving from simply a sort of monetary policy reserve asset diversifier to something that can effectively anchor any form of market system. So any form of payment system, any form of stock market, any form of futures market. So it becomes part of the sort of architecture of the realignment of the financial systems away from the dollar-based, the sort of Western-based system into the Eastern-based system. So it's very much China is looking towards, whether if it makes Hong Kong the sort of new hub of finance, which it's fast becoming, and Shanghai sort of a component of that, then it's kind of recentered trade and it's recentered financial activity. And I think that is a goal. So you got the central bank, you've got the state-owned banks, you've got the same sort of reciprocity with its trading partners in the bigger countries with which it does business. And then you have the market system, which is fully international. And China's been really working towards opening it up to international trade and for international transparency. Then you have that movement towards China.
And what message do you think that China's trying to send the world by doing this perhaps in some unofficial ways?
I think China's actually been more transparent than the West gives it credit for. I mean, it might be that they're buying more gold, for example, than they say they are, and that sort of thing might not be as transparent, perhaps, and they're buying it off of different exchanges in different areas, physically and so forth. But the sort of movement towards these new financial centers, the build-up of the technology that drives the Shanghai financial system, what China does have and has had is a long crisis of 2008. It began with the People's Bank of China working with the IMF to have the SDR, the basket of currencies, to include the Chinese currency. So that was sort of like phase one. And to sort of be involved with the BRICS, be involved with Brazil, for example, with Russia, India, and South Africa, but basically to be involved with the other part of the world in order to have alliances. Bringing in now sort of oil-based partners is very much a sort of strategic growth plan as well, because you need, to survive or to be powerful as a country, you need energy and you need money. And so what it's basically doing is centralizing both. That's being simplistic, a lot of which has been pretty transparent. This movement has had steps that you can follow. We've seen flows increase in Shanghai. We've seen flows increase in Hong Kong. We've seen international traders, international financial partners, international banks all set up shop and move assets. It's not really been that hidden. It's just happened over years. It's not like they woke up one day and said, oh, we're just going to sort of move the entire, or we're going to be the impetus for moving the entire, center of the financial world over here.
Well, so that's really interesting about China. I'm just wondering, does it mean China could be trying to position themselves to influence or maybe lead the gold price discovery outside of Western financial systems?
It's definitely what they're moving towards, because if they're moving towards, for example, a payment system that could have gold as a component or even as an anchor towards that system, as it's a tier one asset for banking, but basically some sort of a format where it's part of their bigger financial or payment system that is being developed, or whoever trades on it, whichever countries are involved in participating on their system, towards also using gold. For example, you could have a certain percentage where they have to have a certain percentage in their central bank in order to have priority, let's say, clearance over the payment system or something of that nature, where it's not necessarily forced, but it's implied that gold has to be, let's say, equivalent to our percentage or our reserve system percentage in gold. And I'm not saying that's exactly what's happening, but it sort of is, because if you look at the accumulation of gold or the holdings of gold in the central banks that are involved in BRICS Plus and are involved in our major trading partners and growing trading partners in China, you do see them also growing their gold. And so as a percentage of their reserves. The reason you have that is to be able to provide liquidity to your financial system, and the other reason is to ultimately have solidity to your clearing system, to your payment system. And so there could be rules that relate to gold, kind of a new kind of a gold standard, where there's a certain amount that's required, or a certain amount in reserve that's required, or a certain amount that the state banks have, or the private banks within a country have. You could go on and on with a very clear list of where gold can come into play. And one of the things that China has done recently is they've actually sort of enforced this percentage of gold, or this ability of their state-owned banks to hold gold, so forth. So it's been very systematic in terms of spreading gold from the central bank, all the way down to the individual in quite a planned way.
So let's just bring it back to the investor level, because I'm curious how this fits in for our viewers. So how might investors interpret these moves by China? Are we looking at early warnings of a fundamental change in the global financial order?
We have been looking at those, yes, developing, number one, because as we move away from the West and the dollar, again, not as a reserve, but as a trading currency, or as more trade agreements are made that don't require the US dollar, and as a global payment system develops, which it hasn't yet, to sort of compete against the SWIFT system, which provides code for payment systems right now, which are dollar-based, then you have the mechanisms for moving sort of that global financial hierarchy away from the US. China, that's not happening overnight. But what it means for investors, and what is happening very quickly, is, going back to gold, the accumulation of like a hard asset anchor, which is gold, and I think will also be silver to a smaller extent, because it can also function as that kind of a tier one type of asset. That gold has this functionality, and in order to have that functionality as an anchor asset to a monetary and a financial and a trading system, well, then it has to be accumulated. You can't just make up gold. Gold doesn't care which governments buys. The more it owns, the more it has control of the national market. So any country can buy gold, and many countries are buying gold. And as China has done, and this is what's interesting for our investors, as China has bought gold in the central bank and has required gold to be at the state bank level and has suggested that gold be bought at the retail level to its entire nation, well, other countries are doing the same thing if they want to trade with China. And China is one of the largest trading partners for most countries in the world. Gold prices have been remarkably stable as they have been increasing towards, now we're at the 3,400 level. We touched 3,500 a month and a half ago. We went down a bit. Now we're sort of creeping back up to that. It's shown remarkable stability through higher inflation, economic uncertainty, more debt. Is the Fed easing or not next FOMC meeting? And it has continued to stay in there because it has a bid from every aspect of China, yes, but also from every form of investor, whether that is a nation or an individual throughout the world.
Yeah. Speaking of this type of monetary power and the tools used to influence global financial systems, another area that you've been quite vocal on that's raising a lot of concern is central bank digital currencies. You've been vocal about their potential impact on privacy and control. So how do you see CBDCs fitting into this broader shift into how nations assert financial power, and what should people be aware of when it comes to their privacy and control over their money?
Well, one of the things about central bank digital currencies is they're not an if, but a when. Most of the OECD countries have some form of digital currency system or prototype or test paper or something in their purview, some more than others. Brazil, for example, has the DREX. China has the CIP system, which is also operated on a digital currency. So, I mean, you have the US Fed is sort of doesn't have one yet. We're actually behind in the US, oddly, on this particular element. But central bank currencies, digital currencies, are going to be part of the future of how central banks operate. What does that mean? That means that they will have the capacity to hold data. So by definition, a central bank digital currency based on blockchain or Ethereum technology effectively will take information. So the extent to which privacy becomes an issue in this, because it's going to happen, is that individuals will have their financial transactions ultimately in a ledger that ultimately a central bank and a government can see. Now, there are a lot of steps in between, someone going to the store and buying something ultimately with a central bank digital currency. Once that happens and once it's a part of, their credit card and their iPhone and everything else, to that kind of oversight from a government. But the data will be available through the architecture of CBDCs. So, which is another reason why gold is a more secure means of retaining wealth, growing wealth as well, because you can't really put a blockchain inside a Boolean bar. So, there is that sort of privacy barrier that gold just keeps. But that said, central bank digital currencies are definitely a concern from that perspective. There are certain rules that could be in place by governments to protect privacies or to denote protection of privacies. But at the end of the day, a ledger is a ledger and information is information. And the higher the level of technology and architecture of systems that will be designated into a central bank's currency, the more that any bank that's a part of that central bank's purview will be funneling up its information to the government, to the central bank. Now, how that gets used, of course, that is a separate matter. We can imagine how it can be used. We can imagine that it can be used, against certain types of people or certain types of purchases. I mean, there's a lot of ways that once data is in the purview of a government, it can be used. That said, right now, I know the U.S. government, for example, can enter somebody's account if they're late on a tax bill because the banking system, the private banking system, is part of the Federal Reserve, which is part of the government. I mean, it operates independently, but it's part of the government. So, I mean, there are already connections. What a central bank digital currency would do is it would allow technology to gather more of those connections and more of that data and more of that information.
Well, it's a really valid concern that people would have about the increased surveillance, I guess, around CBDCs and what the future might hold. I guess, do you think this is going to drive more people towards physical assets like gold to reclaim their financial sovereignty?
I think it's one of the many factors it has. It's not the main factor because not everybody is concerned about it, and it's still something that's really in development. But definitely, for me, I would prefer having long-term investments in different ways in physical gold. And I think that's one of the reasons that we've seen retail and sort of private wealth managed accounts move towards gold. You can't lock a CBDC account or Bitcoin in a vault. I mean, there are definitely disconnects between Bitcoin and a fiat dollar. So there's that aspect that's attractive on certain cryptocurrencies, but you can't really divorce it from its data chain. Gold you can lock away.
And how does this then tie into your broader outlook on gold's role in the years ahead and where price could be heading on that basis?
Yeah, so I only see more momentum, and we were talking a bit before this interview about the sort of role, the period in time that we're in right now and what gold represents. And it's such an exciting evolution in gold's own history. Gold has certainly been around for a very long time, but in terms of more recent history, the gold rushes of, the 1840s across the world and certainly in the United States were about people going to get something real. I mean, that's really what it was. There was that element of let's get rich, but it was also, let's touch it, let's feel it, let's see it, let's save it. And then in 71, of course, when the U.S. basically dismantled the gold standard, it became unmoored from fiat currency, and everything that happened since then was a result. But now we're seeing it sort of reemerge as almost a potentially bigger role now, because the world itself has expanded from a trade perspective across so many more countries. And the supply chains and manufacturing chains and processing chains are so much more, sort of situated towards the east, that we have more of a global role that gold can play in those trades, to back trade, to back development, to back financial arrangements, agreements, and so forth, than we've really ever had before. And you throw technology onto that, and it just enables gold to be used through sort of newly developed systems in that manner. So I see gold being accumulated ongoing by central banks, and it will be in the West too. This isn't just, Eastern European banks are, for example, stockpiling gold. For example, Poland's one of the largest percentage increases of a central bank in that area because of its proximity to the Russia-Ukraine war and having that ability to basically buy its own defense if it needs to. And having a currency outside that's kind of more independent, which is effectively a hard asset, which is gold. That's going to continue. There's no reason for that not to continue. What that's going to mean is it's going to drive the ultimate price of gold up, because you're going to need more and more physical gold. You're not going to have a central bank trade in gold ETFs. That said, you will have ETFs that are moored in gold. But it all comes down to more demand for physical gold. And right now, there's already a mismatch between the demand for gold and the supply of gold coming out of the ground. And if we even look at that staying the same as opposed to growing, which I think it will, but even if it stays the same, you're looking at ultimately more supply needed out of the ground to meet the demand of gold for all of these different roles that it plays today. And what that means is, just in basic economics, there's a scarcity. If there's a scarcity, it's going to push the price up. You can't just start a gold mine and dig for gold. Yes, there are many operating mines in the world and they are producing gold. But then there's also a lot of junior miners that are beginning or at the beginning or middle stages of developing mines that have yet to produce gold. And that will ultimately create a mismatch between the supply that's available and the demand that's growing. That's going to push up the price. So I see prices of gold going up around $4,000 by the end of this year, beginning of next year per ounce in dollars, and $5,000 by the end of the next year, because I think we're in an accelerating phase right now of aggregating gold and also the awareness of gold as this diversification in so many ways asset.
Incredible. Naomi, for those who want to follow your work, where can they visit you on Printsights? Can you tell us a little bit more about your newsletter as well?
Yeah, so Printsights Global is the company I created. It'll be a year and 2 weeks to really aggregate all of the research that I do. We have a newsletter on Substack, which is printsights.substack.com, where there are different tiers of premium to free to high premium research and ideas there that I generate, and have a great team working with me to do that. And again, we're about to celebrate our first year anniversary, which is very exciting. That's grown quite quickly with a really, really nice global subscription base. And that's really the best place to find my most recent work. We're publishing a lot in gold, mostly hard assets, mostly commodities, but also about central banks, about crypto, about energy. So it's a really interesting composite of research to follow.
Well, congratulations on your 1 year anniversary. That's very exciting. Thank you so much for shedding some light on really complex issues today. Your insights have been so helpful. Dr. Naomi Prince, thank you so much. It's been a pleasure having you with us, and hopefully we can do this again soon.
Thank you so much.
If you found this interview valuable, be sure to like and subscribe to our channel for more content. And if you'd like to receive 10 grams of silver free, you can find our sign up link in the notes below. Thanks again to our audience for joining us. I'm Claudia Merkert from Bullion Star, and I look forward to seeing you next time.